If you walk through London in the year 1720, you would not hear the language of prudence. You would hear the sound of inevitability. In coffee houses, thick with smoke and ambition, merchants, aristocrats, widows, and clergymen spoke of fortunes not as possibilities, but as destinies. Wealth, they believed, had finally discovered a shortcut. The South Sea Company was not merely a business. It was a promise that Britain's future riches could be unlocked all at once, without waiting for trade, labor, or time. And like all great financial illusions, it flourished precisely because it aligned hope with national pride. Britain at the dawn of the 18th century was a nation burdened by debt, yet intoxicated by empire. Wars against France had drained the treasury. Government bonds piled up, weighing on public finances. But Britain also stood at the threshold of global power. Its navy dominated seas. Its merchants spanned continents. The question was not whether Britain would grow rich, but how quickly. Into this environment stepped financial innovation, clever, complex, and poorly understood by most who embraced it. The South Sea Company was born in 1711 as a solution to a problem older than the company itself: sovereign debt. The British government owed enormous sums to creditors. The company proposed a seductive arrangement. In exchange for assuming portions of government debt, it would receive exclusive trading rights to South America, the legendary South Seas, a region Europeans imagined overflowing with silver, gold, and untapped markets. On paper, it was elegant. Debt would be transformed into equity. Creditors would become shareholders. The state would reduce its burden. Prosperity would follow. What mattered less than reality was imagination. In truth, Britain's access to South American trade was limited by Spanish control and frequent war. The company's actual commercial prospects were modest at best. But markets do not price reality. They price belief. And belief in 1720 was abundant. As Parliament endorsed successive debt-for-equity swaps, South Sea shares began to rise. Each rise confirmed the story. Each confirmation attracted new participants. The company's directors encouraged enthusiasm with skillful ambiguity, hinting at profits without revealing details. The public filled in the gaps themselves. Prices soared not because trade expanded, but because confidence compounded. London transformed into a theater of speculation. Shares changed hands at breathtaking speed. Fortunes appeared overnight. Servants borrowed to invest. Nobles mortgaged estates. Even Isaac Newton, whose intellect had decoded the universe, was drawn in later, lamenting that he could calculate the motions of the heavenly bodies, but not the madness of people. The bubble did not discriminate by intelligence. It discriminated by exposure. What made the South Sea bubble especially dangerous was its proximity to the state. This was not a fringe scheme. It was endorsed by Parliament, interwoven with public finance, and supported by political elites. Trust in the company was trust in Britain itself. To doubt the South Sea was to doubt the nation's future. In such an environment, skepticism felt almost unpatriotic. The mania spread beyond a single company. A frenzy of imitators emerged, offering shares in ventures so absurd they bordered on parody, yet money flowed freely to them all. One infamous prospectus promised profits from an undertaking of great advantage, but nobody to know what it is. Investors subscribed eagerly. This was not ignorance, it was desperation. When wealth seems inevitable, caution feels foolish. By mid-1720, South Sea shares had risen more than tenfold. The price no longer reflected any conceivable earnings. It reflected momentum leverage and the belief that someone else would always pay more tomorrow. This belief, so familiar to modern eyes, has always been the true engine of bubbles. The greater fool theory does not announce itself as folly. It presents itself as confidence. Yet beneath the euphoria, fragility grew. Insiders quietly sold. Credit tightened. Whispers replaced shouts in coffee houses. When the first significant selling began, prices faltered. Confidence cracked. And once doubt entered, it spread faster than hope ever had. Shares fell. Margin calls forced liquidation. The same leverage that had lifted prices now crushed them. The collapse was swift and brutal. By the end of 1720, South Sea shares had lost most of their value. Fortunes evaporated. Families were ruined. Trust in markets collapsed. The shock rippled outward, freezing credit and destabilizing the economy. What had been celebrated as a national triumph became a national embarrassment. The political consequences were severe. Corruption investigations exposed bribery, insider dealing, and the cozy relationship between the company and Parliament. Ministers fell. Reputations shattered. The state was forced to intervene, not to save speculators, but to prevent systemic collapse. Assets were seized, directors punished. Damage was contained, but the scar remained. Standing amid the wreckage, Britain confronted a painful realization: financial innovation could magnify national strength or national folly. The same mechanisms that promised to tame debt had nearly destroyed public confidence. The bubble revealed that markets, when fused too closely with political ambition, lose their capacity for self-restraint. And yet the South Sea bubble was not merely a story of greed or gullibility. It was a story of transition. Britain was learning to live with modern finance, joint stock companies, public debt, liquid markets, without yet understanding their psychological power. The bubble was the tuition fee of financial modernity. What followed would shape Britain's future profoundly. Regulation tightened. Financial culture matured. The memory of 1720 lingered for generations, whispered as a warning against speculative excess. But memory fades. And as history shows, every generation eventually convinces itself that this time is different. As I look back on the South Sea bubble, I see not an aberration, but a prototype. It contained every element that would reappear in later crashes: state endorsement, debt alchemy, narrative-driven valuation, leverage, insider advantage, and collective denial. It taught Britain that markets amplify belief faster than reason, and that when money, politics, and dreams intertwine too tightly, the unraveling is never gentle. And as the dust settled over London, amid broken fortunes and broken trust, a deeper question emerged, one that would echo through centuries of financial history: whether modern finance could ever truly discipline itself, or whether every innovation carried within it the seed of excess that would eventually demand correction. A question that would not be answered immediately, but slowly, as Britain attempted to rebuild confidence, impose order, and extract lessons from a disaster that had exposed the raw psychology beneath markets, a psychology that would resurface again and again whenever speculation outran substance, a psychology that would soon be confronted as Britain moved forward into a new era of financial power, carrying with it the memory of a bubble that had promised the world and delivered ruin, a memory that would shape laws, institutions, and attitudes in ways that only became clear after the panic subsided and the nation began to ask not how wealth had been created so quickly, but how it had been lost just as fast, an inquiry that would inevitably lead to a reckoning that reached far beyond the balance sheets of ruined investors and into the very architecture of Britain's financial state. For once, the euphoria evaporated. The nation was forced to confront an uncomfortable truth. The South Sea bubble was not an external shock imposed upon an innocent system, but a product of the system itself, of how Britain had chosen to merge public finance, private ambition, and collective imagination. The immediate response was anger, sharp and indiscriminate. Parliament launched investigations that peeled back the facade of respectability surrounding the company. What they uncovered shocked even a society accustomed to patronage and privilege. Shares had been distributed to ministers and courtiers, in advance of public announcements. Bribes had been paid not in cash, but in equity, an early demonstration that financial instruments could conceal corruption more elegantly than coin ever had. The bubble, it turned out, had been inflated not only by popular greed, but by elite complicity. Punishment followed, though selectively. Several directors were disgraced, their estates confiscated to compensate victims. Yet the system itself was spared dismantling. Britain did not abandon joint stock companies' public debt or financial markets. Instead, it absorbed the lesson in a more subtle way by tightening rules, strengthening norms, and embedding caution into institutional memory. This response would prove decisive. Unlike Spain, which defaulted repeatedly, or France, which recoiled from paper finance after John Law Britain learned to reform without retreat, the Bank of England emerged stronger from the wreckage. Its role as a stabilizing counterweight to speculative excess became clearer. Public debt, though dangerous when mismanaged, was not abandoned, it was disciplined. Transparency improved. Parliamentary oversight expanded. The bubble, catastrophic as it was, did not destroy Britain's financial future. It shaped it. This is why the South Sea bubble matters so deeply in financial history. It was not merely a crash, it was an education. Britain paid dearly to learn how modern finance behaves when narratives outrun reality. And having paid it, adapted. In the decades that followed, Britain would finance empire industrialization and war with a sophistication unmatched by rivals. The memory of 1720 acted like a governor on a powerful engine limiting speed, just enough to prevent explosion. Yet even as institutions matured, the psychology revealed by the bubble never disappeared. Speculation did not end. It evolved. Each generation found new narratives, new instruments, new justifications. What changed was not human behavior, but the scaffolding around it. Regulation learned to anticipate excess, not eliminate it. Markets learned to recover faster. Crashes became survivable even if still painful. The deeper lesson of the South Sea bubble lies precisely here. Financial crises do not end capitalism. They refine it. They expose weaknesses, redistribute power, and rewrite rules. The South Sea bubble taught Britain that markets are not self-correcting in the moment of mania, only in the aftermath. It taught that state endorsement amplifies risk rather than reduces it. And it taught that when debt is transformed into dreams, someone eventually wakes up to find the bill unpaid. When I reflect on 1720, I see a mirror held up to every modern bubble. The language changes: railways, radio.coms, housing, crypto, but the structure remains. A compelling story. Official blessing, easy credit, rising prices, moral justifications. Then suddenly silence. The South Sea bubble was not primitive finance stumbling blindly. It was sophisticated finance discovering its own shadow, and perhaps that is why its legacy endures. It reminds us that intelligence does not immunize against collective belief, that authority does not guarantee value, and that markets are as much emotional ecosystems as they are mathematical ones. Britain survived the South Sea bubble not because it avoided folly, but because it learned from it without denying it. This is the final lesson. The crash left behind. Financial innovation is never free. It charges tuition in crises. Those who pay attention graduate. Those who forget repeat the course at higher cost. If this story of the South Sea bubble changed how you see speculation, state-backed narratives, or financial manias, share what struck you most. And if you want to continue tracing how these ancient patterns resurface in modern markets, follow the channel and stay with this journey, because every bubble leaves behind a lesson. And history's most reliable trick is convincing the next generation that they no longer need to learn it.